Thanks. So there's a lot of subjects there. Complexity, regulations, volatility, resource management. There's a lot of pieces to that. So maybe picking on a particular one. So I guess there's a comment at the beginning about titles and that they're changing. I mean, there's a title that seems to be a bit more popular now with words like resource management somewhere in the title. Right? It seems to be a different word. I don't know when the first time I heard that. It might have been a year or two ago. But valuing OTC products, so valuing a swap has gotten a lot more complex. What are we moving towards? We're moving towards a world where this idea of rare resources, scarce resources, I think is another title that I've seen. Scarce resource management. So in terms of collateral, in terms of capital, in terms of risk, is that the future, or is this a stopping point along the way? So maybe I'll kind of start at the opposite end, Murray, if you want to have a few thoughts or any comments on it.
Honestly, can you clarify a little bit more? I think there's a lot of areas.
Too much there. So basically, the valuing derivatives got more complex.
Right.
So the idea of managing the components of that using this new job, resource management, scarce resource management, is the way that we're heading towards something where the bank is going to manage and look at all of the aspects of the trade in that vein. So capital is scarce. We're going to charge for it. We're going to manage it. Liquidity maybe falls under that at some point. That's kind of the
Right. Thank you. I think. Yes, it will definitely influence, and I think the scarce resource and capital is one of the biggest resources right now, and I think the banking industry is pressured by a lot of different areas, and not just talking about the trading business, but talking about all the other exercises and regulatory pressures which come on into place in the last year and will come in the next 2 to 3 years. So there will be definitely discussions around in the banks. That's for sure. How to and who, and even who can take the risk on, and which desk can take it on, and also the limit pressure will come into place in terms of how do we distribute the limit and how do we charge for each of the specific risks. Do we do that on a desk level? Do we do that on a management book level? How are we going to manage that? And that will depend on the structure, the infrastructure available in the houses and in the banks, because it is not easy just to calculate an overall number for portfolio. That's one piece, but the second thing is how do you distribute it to each of the single product levels and the traders. That's not something that you do easily and implement easily. And then the second piece is like, how do you manage that in an efficient way? Is like having the risk on the book is one thing, and then saying like, how do we manage and maybe hedge the risk? Is it even possible to hedge this risk, or is it just a risk that we need to leave open as a reserve? I think these are, so from that end, yes, it definitely will increase.
I mean, given the fact that hard requirements to calculate CVA, DVA are here, for example, only since the start of last year with the start of IFRS 13. Before that, it was sort of optional, or depending on your business model required, but there was no regulatory framework which actually required you, or accounting framework which required you to calculate CVA, DVA. So we're in a world where for the last, say, 12, 15 months now, most of the banks, sort of fingers going up in the air, when Rowan asked which bank is actually calculating CVA. So this is no requirement. You have to calculate something. What exactly is a different topic. And as I said, it's a rather complicated business. And I think it's difficult to expect that after 1.5 years, everyone has set up a framework which is fully available, able to optimize the portfolio with respect to all the XVAs and capital requirements at the same time. So I think there's a lot of work in progress. We see it's one of the good things with our traders, they actually are aware of the topic, and there's a lot of discussions going on. But the way to a really fully integrated steering of all the numbers and regulatory capital, I think this is still a long way to go. And this is nothing which I would guess is taking place in the next month. But I think we're talking more about years. So especially for smaller banks, resources are always scarce. There's a lot of other regulatory topics besides XVA which you have to account for. And so this is just one of a bunch of topics, and therefore that, of course, will sort of extend the process of getting a framework for that up and running. But it's definitely a topic.
I think the market will be more fragmented. There will be kind of plain vanilla trades with the clearing houses, and there will be the other portfolios. And the other portfolio, the legacy portfolio, the bilateral portfolio, existing portfolios, will shrink. And we see quite a lot of banks offloading risk or counterparts and trades that in the past were considered as prime. So I'm not sure if on this bilateral side we'll ever have models that will calculate all XVA components in one go. I think there will always be a slicing and dicing of the portfolio for FVA, for CVA capital charge, counterparty, credit risk, RWA, leverage ratio, so that the portfolio will always be under a different magnifying glass. And whichever resource is the most scarce in an organization, this will be how the portfolio is steered. Mm-hmm. And one of your questions, Dirk, is why your traders don't come to you and make proposals if you don't charge them. I mean, that was the same in our organizations. In theory, yes, they should have cared about if collateral was posted in an efficient way. But as long as so as soon as you charge them with costs, they manage the portfolio and they come up with ideas to
Probably the costs
reduce.
are not high.
Maybe they are not high enough.
I guess they're not high enough. That's okay. Maybe the problem.
That's another thing. Okay.
I think what Birgitta mentioned is quite crucial for the front office. Yeah. If they are not charged, they are not interested, definitely. I think what we achieved is at least sensibility that some resources are scarce. Yeah. So we have to manage them. Maybe we are afraid that some resources will be even more scarce in the future when we are talking about the exemption, reconsidering the exemption rules for non-financial counterparts under CVA capital risk charge, for example, or talking about the new standard approach, counterparty credit risk, especially for uncollateralized deals, makes it very, very expensive. So I guess sensibility is there. What's hard work is to get transparency about what portion of this scarce resource is absorbed to any deal on a deal level and best in portfolio context. Yeah, this sounds very easy, but it's definitely not. And I think that is quite crucial. And in the end, it's a kind of alignment of interest. Yeah, I think it's a question who is in charge of that scarce resource. Is it sales guys? Are the sales guys responsible for the profitability of the relationship, or is it a cost that is allocated to the front office? Or maybe it's a kind of joint book that both are charged the cost and have incentives to reduce that RWA consumption, for example. There are many quick wins which you can do. You do that quite often, kind of recouponings, kind of trade compressions where you can easily save some money. And one should use or try to use that possibilities to get quick wins. Yeah. But it's important to get the salespeople in the boat. Yeah. You have to pay them if they are able to get some relief on your scarce resource.
Okay. Yeah, I mean, I certainly see the landscape continuing to evolve and us needing to deal with the various cost elements, and scarcity will continue. I mean, I think the CVA exemption is a big deal for European banks. If that gets removed, I think it has some serious implications for the business models and how we charge for those deals. The other thing is that it's also quite interesting in XVA space is this question of overlap, right? So, I mean, we calculate all these XVAs, and if we price them separately and add them up, we're never going to do deals largely, right? So the question is, how do we understand the pricing we see in the market? How do we make sense of it? And does it make sense, right? So I think overlap's a big one, and even if, standalone methodologies of CVA are well established, the interaction of the various VAs, I think, are not so much. And the other thing I'd point out in this landscape is the impact, again, on governance and KPIs. So a couple of the themes that have been talked about, which is, how does it change the way the business is run and steered, and who makes those calls, and who sets the binding prices, and are the charges binding, and how does management make those decisions, sometimes in the context of not fully understanding what an XVA is. So I think that's something we all struggle with, and we'll continue to.
Okay, thanks. There's quite a lot of stuff that interesting stuff to cover. So maybe I might suggest switching, and I might just ask individual panelists a question, and others can comment, and that way we can get through more questions, because there's a lot of, even as answering these questions, a lot of good stuff is coming up. So following on a little bit around your subject of Jeremy, about where how you price, where you price yourself out of a deal, what are the aspects there. There was an interesting survey recently of 20 banks, 20 international banks, and there was, the result of the survey was there was a noted convergence in terms of pricing. It was sort of interesting in two ways. And in one sense is that the banks didn't think that there was a convergence because they thought everybody else was doing something different, but when they actually said what they did, everybody was doing the same thing. So it was sort of interesting from that perspective. So without realizing it, they're all sort of, or not admitting it, they're all converging in terms of CVA, DVA, and actually even FEA. So 85% of them were charging CVA, DVA, and FEA to clients, right? Which might be a sort of a surprising statistic for some. But from your perspective, what's your experience in this? What do you think makes sense to charge to clients? Would you charge KVA? Would you charge, your laundry bills? I don't know, whatever else you want to.
As much as you can.
Okay, yeah, exactly. But the basic framework is around covering your cost of production. So that is your CVA, your funding, and putting a capital hurdle on the transaction. So I think that's probably the consistency, that survey speaks to. But where the inconsistency is how those ingredients are put together. So, picking on just one, if you look at on the funding side, obviously I think it's Totem does their funding survey. It's grown quite significantly in terms of number of participants, which gives some transparency into how banks price or think about funding. And you see quite a large dispersion in those prices. So sure, everyone prices it, with a couple of exceptions that we see in big banks. Smaller banks probably less so. But anyway, even of the ones that do price it, they price at different levels. And why is that? Well, is it because funding is an internal cost? Is it a market-based cost? Even if you agree on that question, how do you How do you come up with the market price? So there's a lot of scope for divergence in pricing. What else do I see? And you also have this aspect of changing environment. So if you're going to price a long-dated cross-currency swap with a European corporate, are you going to price in the CVA VAR overhang? If you are, you're probably not going to win the deal where we see pricing these days. So I mean, those are the kinds of things. We think about, and I think the market continues to evolve, and as a result, we constantly are refining our pricing to kind of strike the right balance between doing deals that we want to onboard, but putting the right hurdles on deals for the right reasons. So that's kind of a general answer, but I mean.
Okay. Any disagreement on the panel? Any?
To push the button. We had a similar survey in the German banking market. I'm not sure if this firm survey. I'm not sure if about 10, 11 German banks which participated. So probably not that international the setup as on this survey, which we just discussed. And then there was no question on the actual pricing, so there were no sample deals where you could say, okay, this is the price, and whatever your calculation method is, it turned out that the prices are quite close. But the survey focused more on the methodologies behind it. So do you do simulations, add-ons, historic PDs, implied PDs, etc. And if you look at the variety of methods employed by the various banks, about 10 or 11 banks participating, I would be very surprised if the prices turn out to be very close to each other. So either the trading department, when they actually go out in the market, just adapt to the market and forget everything which is calculated internally, and just react to what more sophisticated banks might quote. If they actually stick to the internal calculations, I would be very surprised if you see a very narrow range of prices in the market. So from the other survey, my expectation would be that we see a big price range on XVA.
But the one thing that is clear, I mean, I suppose even within this realm of difference, is that the costs of production have gone up, and they will continue to go up, and certainly and we see that in where we trade. We see that in how salespeople and clients respond to the charges. I think there's more understanding and more reception, if you will, or acceptance of the fact that the cost of doing these businesses has gone up, and arguably will continue to go up if these regulations continue to unfold as they seem to. So that's another, I guess, dynamic we see.
Yeah, and I mean the clear intention of the regulator is, I think, to reduce business volume. So unnecessary trading, whatever that is avoided, and certain clients might choose not to trade at the costs that are debited. And I think it was said earlier on that areas need to come together. So if a product doesn't cover its costs, if the client if the client, for example, just does a trade from time to time and keeps the trade until maturity, if there are other areas in the bank that warrant these, maybe not covering the entire cost, that they can subsidize a trade on the derivative side, then that's fine. But clients have said that where in the past they had 20 counterparts to price certain products, now they've got only 10 or even less. So clients need to make adjustments for the increased costs that banks are facing, and that's not going away. So I think the volume of business is definitely going down.
Okay.
Maybe I can add a question. Is it intended to reduce volumes on this good part of derivative business, which is related to the real economy? We get a massive cost increase for corporates, And maybe that leads to the decision within the corporate that hedging is too costly because the banks will roll over the cost, and so they are unhedged. Yeah. So this is a question where it's kind of break even. Yeah? When does it make sense for a corporate to hedge and maybe choose, instead of a floating loan and a swap on top of that, choose a fixed loan and get rid of CVA. Yeah, the risk is the same. Yeah.
Yeah, that's an interesting point. So yeah, the net effect in terms of corporate hedging, I guess that's the question. Is it going to mean that that a firm that has a good economic reason to want to hedge may not decide to hedge because it's a little bit too expensive, or because there's not quite the liquidity, or it's too much effort? So all of the burden around doing that, the regulatory stuff. I mean, GE is quite big news at the moment. There's a lot of big news. So maybe we'll come back to that at the end. So I have a question. I guess, Rainer, this is one you can dodge if you want, because I don't know if this is up your alley or not. But basically, it's something that I hadn't really thought about myself. So it's the subject of you got a derivative and there's a price, and of course there's one price, because that's what all the quantitative people think. But I was corrected, and it turns out it's not bad enough that there's CVA, DVA, FVA, and all this stuff. There's also 3 versions of all of those, sort of, right? So there's one for the markets, where the market trades. There's one for the regulators, so where they will sort of have you mark your book, and then there's one for the accountants. So those 3 different prices for the same asset can have impacts in terms of how you hedge, in terms of how you slice and look at your exactly the same portfolio from different ways. Is that something you see? Is that something you experience? Do you see convergence? Do you see divergence?
Difficult question, and maybe it's time for kind of global disclaimer. Yeah. Everything I'm telling here is my personal view, and not the view of DZ Bank. Maybe we will see some convergence. Yeah, we have seen this recent EBA paper, where the regulatory approach is CVA should be treated more as a market risk. Yeah. I guess we have some convergence, or we'll see more convergence on the accounting side of CVA and the economic side. That will converge to some extent. Maybe we will touch the topic of market implied PDs, if the debate is closed or not, later. But would say we are far away from an ideally pricing. Ideally is quite holistic. We read a lot about very holistic approaches, where you just have the look of the bank and just decide whether that trade is good for the bank, and what cost it produced, and maybe what benefits. We can put any cross-selling effects, if there are any, inside. That is the ideal world. In practice, that's definitely not. So I think when we're doing business, it's quite important to have a decision what the front office is charged from other desks. What is the price for collateral, for funding? What are the prices for regulatory capital absorption? So that might not be the best solution. So,
okay,
far away from an ideal world, would say.
Any other thoughts? Any contrarian views on the panel?
Not really contrarian. I agree that, or I think that's what he said, I'm not sure, that there won't be convergence, but there will be more transparency. So when a trade is done, the trader will, or the organization will know what the implication of the trade are on the balance sheet for an accountant, and what it will do to the regulatory requirements. It doesn't mean that the prices will merge, but implications of now on all of these parameters, on all of these aspects, will be known, and this is when, depending on what the management wants the bank to be, or wants trading to steer, if it should be the regulatory aspect, the accounting aspects, they all exist at the same time.
Okay, interesting. So I guess, Brigitte, on that sort of a little bit along that subject line around the regulatory costs and the difference between some of the regulatory charges, RWA versus what you might look at from a market perspective in terms of hedging. So sometimes there's the disconnect between the regulations and the way the market trades means that you have to make a choice between hedging or optimizing your capital cost or minimizing your market risk. So what's your thoughts on that?
It depends very much what the rare or the scarce resource is. If there is plenty of balance sheet, capital might be the scarce resource. If both resources are kind of both, or if all resources or certain resources are limited, it depends on how much you can draw on different resources. So there is always a trade-off. You can't optimize everything, or you can't. Your optimization function will have certain parameters, and sometimes there is what is good for balance sheet might be bad for capital. What's good for capital, or as I said, the example on leverage ratio implied capital cost. There are certain counterparts that, risk that currently have this zero risk weight. So there are no credit RWA, there are no CVA capital charges, but leverage ratio implied capital cost. So depending on how you steer the business, there's always a trade-off. And it depends on internal limits or internal cost incentives, because that I think is also very important. There needs to be a decision on how business should be steered, and depending how this is done, you'll manage that trade-off. But it's always a trade-off, and it's not an easy decision.
Okay.
I think the most extreme and perverse example is the way in which CVA market risk hedges are treated in capital currently. So basically, let's say you decide you want to minimize your P&L volatility. You're putting in the market risk hedges on that into your market risk capital as naked. So it's a perverse outcome of the current regulatory regime, let's put it like that. And hopefully it gets cleaned up in the FRTB review. And this is the kind of this convergence I think Rainer is referring to.
Regarding the organizational setup, if you have a front office department which sort of combines all these functions from variation adjustments to capital charges, probably leverage ratio calculations, into one group which centrally steers the resources, as at least sounds like they're doing that at Commerzbank. I think then you're probably quite close to finding local minima at least, probably not the global minimum, but at least local minima. But I guess at most banks, all these figures are calculated in various departments. Yeah? So you have part of that calculated in the front office, part in risk, part in finance, part in the regulatory reporting department. They all work on different time scales. So intraday on the trading side, more end-of-day focus on the risk side. Regulatory reporting, I hope I don't say anything wrong, is slightly still even longer than on an end-of-day focus. So typically a few days to end-of-month calculations. And then of course, you're completely unable to do any minimization. You can't do that on a monthly scale trying to optimize your portfolio. So I think that this is very difficult to achieve unless you really combine all these functions in a single group which manages these resources for the whole bank. But then, of course, I think this is rather challenging because you need to get all the people on board. You need all the trading departments the other trading departments be willing to pass over parts of their responsibilities, parts of their P&L probably, to that desk. And you need the right people to actually, which understand all these different figures, because it's a vast area of regulation and accounting requirements which you're covering, and so that's a rather difficult thing to do, I think.
Okay, very interesting.